The first ratio in this list is PE ratio, that is price to earnings ratio. This ratio shows that how much an investor is paying for each rupee of earnings of the company. This ratio shows that whether the company share is undervalued or overvalued in the market. There is no ideal PE ratio in the market. Therefore, the investors can compare the current PE ratio of the company with its historical PE ratio, an industry average PE ratio, and market PE ratio. For example, if the current PE ratio of the company is 18 and it is quite expensive if we just compare with the historical PE ratio of the company. But if the industry average PE ratio is 22 and the market PE ratio is 25, then it is a good decision to buy the company shares. The second ratio of the list is price to book value ratio. The price to book value ratio compares the market value of the company with its book value. If the price to book value ratio of the company is less than 1, then it indicates that the company's shares are undervalued, as this ratio compares the value of shares of the company to its large tangible assets. However, the less than 1 price to book value ratio also indicates that the company might have more liquid assets, for example, banks and financial institutions. The next ratio in this list is debt to equity ratio. This ratio shows the capital structure of the company. It shows that the company is how much leveraged. That is, how much the debt the company has taken with respect to its equity. As the debt is more riskier in comparison to equity, however, the debt is more cheaper with respect to equity. But the low debt equity ratio is always considered the better. The next ratio is operating profit margin. This margin shows that the efficiency of the company and the pricing power of the company. Higher the margin, higher the efficiency level, which indicates that the company is able to generate good amount of profits out of its operational activities only. Since there is no ideal operating profit margin, then for analyzing a company, an investor should compare the current margin with the historical operating profit margin of the company and to other companies' operating profit margin in the same industry only. The next ratio is EV by EBITDA. This multiple is often used for the calculation of the value of the company, where EV, that is enterprise value, is equals to market capitalization plus debt minus cash. This multiple gives a more accurate takeover valuation of the company because this multiple includes debt. A lower multiple shows that the company is undervalued, but it is also important to know that the high multiple is for the fast growing industries, while it is low multiple for the industries that are growing slowly.